This meeting is being recorded.
Hello. Okay. Hello, everyone. Welcome to the Microstructure Exchange. We're back for our, I guess this is the winter 2022 season. I believe this is our inaugural presentation by Yashar Barardehi. Oh my God, he coached me on it.
That's very good.
I'm so sorry, Yash. But he's going to be presenting a talk to us. And before I hand it off to him, I'm going to kind of go over kind of the rules here. So Yash is happy to be interrupted. So if you have questions, please just kind of jump in. If you cannot talk or you don't have a mic or something, you can put it in the chat. And you can flag me and I will read it out to him if that's something you would like me to do. Yash is also happy to stick around past the top of the hour. So the first 45-ish minutes will be, the talk, and then the remaining 15 will be a live Q&A. And, Yash will be around for as long as there's questions after the end. We have, I think Dan, I don't know if Mitch is here. They're in the chat, but they may or may not be around to answer questions. So, if you have like co-author type questions, maybe you'll get an answer in the chat, fingers crossed. Okay. And so kind of without further ado, I'll hand the floor over to you, Yash.
Thank you very much. I really appreciate the opportunity to receive feedback with this group of great minds here. Looking forward to any comments here. So this is a project joined with Dan Bernhardt, Zita, and Mitch Warachka. But before I begin, I should put up the disclaimer from the Securities and Exchange Commission, given my current affiliation with them. So basically, they accept no responsibility for whatever I say here. So they're not accountable for this. This is my own view and the other authors' view, not the securities, the commissioners, or the staff. So our project basically addresses debate about whether retail investors possess stock-specific information about fundamental values, or whether they simply provide liquidity to other market participants. Well, this is a 2-decade-long debate, in part because empirically observing retail trading activity is difficult. Now, recently published Bomer-Jones Zhang Journal of Finance paper has this super clever observation that any trade execution at non-midpoint sub-penny transaction prices necessarily originate from retail investors. So this type of transaction represents what we call like internalized trade. And internalization is a process through which a wholesaler, a type of off-exchange market maker, would basically provide execution services to buy and sell orders. And by intermediating, she would make or gain from the bid-ask spread in essence. And in this process, she's willing to make a payment to a retail broker who is basically representing the retail investors, so that the wholesaler is allowed to handle the retail order flow. And also the wholesaler offers some price improvement relative to the best quoted prices on the market that is passed on to the retail investors. So the innovation here was that, well, you can observe these price improvements in the form of sub-penny price increments. So that's the way you identify retail trades. Now, BJZZ's algorithm has a way of classifying trades into buy and sell trades, so that they eventually can form a retail flow imbalance using this classification, which they denote as MROIB. So we're going to religiously keep that notation and go forward with MROIB as our notation for marketable retail order flow imbalance, which is picked up by BJZZ's algorithm. They provide striking, robust, and extensive evidence that this measure of retail flow imbalance predicts future returns. And despite all the robustness and strong results, they are very cautious to conclude that this is only suggestive evidence of retail informed trading. Very interesting paper, very important paper. I think a lot of future work is going to be built on this paper, and we hope that our work is one of those. So what we try to do in this paper is to basically step back and view the variation in MROIB, or the imbalance in this internalized retail order flow, in the context of economic choices by wholesalers. So we're going to view the wholesalers as agents who maximize profit or internalize retail order flow to maximize profit, observing order types, the profit margin associated with internalization, the competition from other participants, as well as inventory control considerations. And we allow for the possibility that profit maximizing strategies might lead to internalization of unequal amounts of buy and sell retail orders, which would in turn create imbalances in MROIB measure, or retail order flow, which essentially means that whatever you see in terms of imbalances of MROIB has to do with the wholesaler's discretion over internalization. In order to make our case, we also highlight the importance of single dealer platforms that are affiliated with wholesalers oftentimes. These are platforms, well, a wholesaler basically trades as a principal, trading on a principal or a riskless principal basis against third parties, providing trade executions. And these platforms are also known as VIP one-sided dark pools, in the sense that typically institutional investors try to access, or who are willing to access the liquidity in these pools would have to pay a fee in order to get access to this liquidity pool. And the wholesaler sources liquidity either from retail broker customers they're working with, or the ATSs or exchanges. And in the end of the day, you can imagine a situation where the wholesaler internalizes, for example, more retail buy orders in order to provide liquidity to institutions who are willing to sell. Thank you, Cameron. I thought that was a question. Okay, very good. So in this sense, we're going to try to interpret MROIB as an inverted proxy of institutional order flow. If you believe our story, that's basically
how I'll double check. Okay, $5.06.
Okay, and then observing this, we conclude that the predictive power of MROIB for future returns could be attributed to price dynamics associated with institutional price pressure that is subsequently unwound and has been documented in the literature quite extensively. In terms of contribution, to the best of our knowledge, our paper is the first to provide evidence of retail investors providing liquidity to institutional investors. And in doing so, we obviously contribute or extend the literature on the information content of internalized order flow, as well as the literature on the liquidity provision by retail investors. The part of our analysis may shed light on a mechanism through which payment for order flow arrangements may harm on-exchange liquidity, and that has been extensively studied in the literature, including a recent working paper that was actually presented at the Microstructure Exchange about a couple of months ago, I believe, by Emerian and Norton. They're not directly looking at PFOF, but they have some sort of off-exchange market making situation harming on-exchange liquidity. Our findings also helps us rationalize the distinct nature of overnight and intraday returns. So there's a recent literature that tries to understand why those returns are so different. Their average levels are different, their dynamics are different. they're related to one another in a way. They're related to like successive of their own type in another way. And we have a way of contributing to that literature, actually. Before getting to the paper, I will have to go through a bunch of institutional details. I'm sure a lot of you are quite familiar with this, but for the sake of making sure that everyone is on board with what I'm saying, I'm going to go through this. So as everybody knows, I suppose here, the quotation and execution in US equity markets happen at 1 cent tick. There are key exceptions to it. The two important ones include the following. First, institutional investors may quote and trade at midpoint prices as long as they're trading off exchange. And retail orders may be executed at sub-penny prices. So there's a difference between quoting versus execution. Retail orders are always quoted at 1 cent increment, but the execution can happen at sub-penny prices. So I want to make sure we distinguish these two concepts here. And the conditions for that to be allowed is that, first of all, the sub-penny increment must constitute a price improvement relative to the NBBO, and the execution must happen off exchange, in particular, provided by a wholesaler. So if you look at, say, TAC data, and then you observe a transaction with an exchange flag D that has an execution price of $10 and 2.9 cents, you're looking at a retail trade who has a sub-penny increment of 0.9 cents. And this is what the econometrician can observe and hopefully use to learn about markets.
So can I ask a question about this?
Sure.
So how often is it the case that that trades are actually, retail trades end up being executed on kind of the sub-penny increment? That's
a great question. I don't think that I can give you the answer. So I'm sure there is regulatory data that would be reasonably resourceful to answer that question. So in essence, you need to know every single trade or every single retail order, right, that is ever executed, and then those that are receiving price improvements. But my belief is that it's a big number, right? And I think that if you looked at BJZZ, they actually have a way of verifying, at least for the marketable orders, using the data they have from NASDAQ. They sort of match the trades identified by their algorithm and those that they know are retail trades. And I think the matching is quite impressively accurate, at least for the marketable orders.
Okay, thank you.
Yeah. So I would like to also talk about a little bit the business model of wholesalers, just to make sure we're on the same page. And the reason I want to do this is that I want to point out that the aggressiveness of different order types that wholesalers might face actually matters for their choices. We're going to see that down the road. So that's why I'm putting up this picture. So suppose that we have an order book with a bid-ask spreads of 6 cents. That's like the average in our sample, actually. That's why we picked that number. I'm only showing you the buy orders coming in. Suppose that wholesaler is basically receiving order flow from the buy side, and these are the potential types of orders that could come in. You could have a market order. That's basically an order seeking immediate execution at the best available price, right? This is probably the type of order that is most appealing to the wholesaler because they can simply take that and flip it over to a market sell order from the opposite side, and there's a wide spread between them for profit. You could also imagine marketable limit orders. They are also seeking immediacy. Nevertheless, they're specifying a limit price, and as long as that limit price is as good as best ask price, they're qualified to be marketable. They are almost equally appealing to the wholesaler relative to market orders because they can be flipped to a sell order from the opposite side, and then there's a spread. So probably the key type of order that I want to point out here are the non-marketable orders that are still attractive to the wholesaler because they are priced in the range that is between the best ask price and the midpoint. So to the extent that there is room for these orders to be flipped over to an order of similar type, or more appealing on the opposite side, there's going to be profits to be made, and these would be also orders that wholesalers would be happy to work with under certain circumstances. So 3 order types: market orders, marketable limits, non-marketable limits that are priced between the NBBO and the best price on the same side. All right. So the other piece of the puzzle here is, what are the incentives for the wholesalers to provide the payment for order flow and price improvements? So essentially, the wholesaler is incurring a cost in this internalization process, and that cost nominally includes payment for order flow and the price improvement that is passed on to the retail investor. So the main incentive for the wholesalers to want to incur this cost is the fact that by getting to handle a retail broker's order flow, they are essentially purchasing the option to fill these orders or these retail orders before any other market participants is even aware of their existence. And that's a pretty darn good advantage. So that's the main incentive, but mostly explaining why payment for order flow exists. In terms of price improvement, why there should be a price improvement, you can think of the best execution principles that the SEC and FINRA sort of require. And they basically reflect a requirement where wholesalers and retail brokers must execute customer orders at the best reasonably available terms, okay? So typically the benchmark for that is the NBBO, right? However, I guess it never hurts to sort of improve over that a little bit, and that's where the price improvement comes in. So in essence, by offering a tiny bit of price improvement over the NBBO or the quoted price of the order generally, the wholesaler retail broker agreements make sure that whatever order flow that is internalized is abiding by the best execution principles, right? So in essence, what happens in the internalization process in an example would be, all right, you have a buy order that is quoted at $10.03. The best ask is $10.03, but the execution happens at $10.02.9. So what is going on is that a 1/10 of a cent price improvement is passed on to the retail investor, right? And the retail broker is rewarded by the agreed payment for order flow associated with this transaction between the retail broker and the wholesaler. So 2 types of payments happening here. Lastly, retail brokers use price improvement statistics for marketing. If you check out, say, Charles Schwab's website, TD Ameritrade's websites, and so on, I have no doubt that you will find a section where they talk about, or they brag about, the very large percentage of marketable orders that they execute at the NBBO or better, right? So the or better basically refers to the price improvement that happens in this process. Okay, so after laying that,
can I ask at this point?
Sure, Albert. Hi.
I think I followed the logic. One thing that you didn't mention is that there must be a consideration when I'm the retail broker. I realize that when I price improve, strictly in the way you just described, it's going to go to the print and everybody knows that was retail flow. I might actually prefer not to do that, because if I just bring it in at a full cent, then nobody else knows that what I saw past my what passed me, it was retail order flow. So I sort of keep hidden from the rest how much of the total volume in this current interval is retail, which is a strategic benefit for me. You see what I'm saying? I frozen?
No, I think I heard you. I don't know.
I can you hear me, guys?
Yeah.
I think I couldn't hear. Sorry, Albert. I think I only hear to the point where you said the retail broker might have an incentive to not offer price improvement. If I heard it correctly.
I see the marketing that you mentioned in the last bullet point. A disadvantage for a retail broker is that if I price improve on not a full cent, then everybody in the logic of Emroy knows when it goes to the print that this was retail flow. I might actually prefer to keep that as private information, to not let the rest of the market know that in this interval or this period of time, there was a lot of retail coming to the market rather than institutional flow. So that gives me a strategic advantage knowing how much of the total flow is retail. So I prefer to keep that to myself and trade at a full cent rather than these what do you call them, imperfect, non-integer cents, we call them that one. You see what I'm saying?
Yes. So if I understand correctly, I think that you might be suggesting that so you are suggesting that there's an advantage in keeping the information about the composition of order flow to the retail broker, right? They have this disadvantage, and I suppose that could be used potentially to trade against that flow if it is informed to profit, maybe. So I'm trying to think why they want that. And if that's the explanation, I think that the SEC and FINRA explicitly ban trading ahead of customer orders. So that's like a very big crime, essentially from the FINRA's perspective. If I'm not mistaken, I think there was some sort of scandal about it with one of the brokers in the past. Don't quote me on this.
No, I understand. You can't trade ahead of your client flow. That is there since a long time. But that information I know, going forward after I executed my flow, I can either reveal it to the market by trading at a 0.029 or at a different price, which is a full cent that people don't know if it was institutional or retail. I can use that going forward. Anyways,
no, I understand. So basically, I think that you're pointing out at a different selection issue with the algorithm that we're talking about, and that selection issue comes in the form of no price improvement, as a result not detected by the algorithm if there is information content as the retail broker sees it. So I can't argue with that point, because obviously that's something that is not picked up by this algorithm. What we do in this paper, I think, is actually consistent with what you say, in the sense that we show another selection problem with this algorithm, in the sense that we show that when they offer price improvement, there is institutional order flow on the opposite side of the market that they are catering to, which is consistent with the fact that the the retail order that they're internalizing is not informed. So they're basically internalizing to meet the liquidity needs of their institutional customers. Which I think is pretty consistent with what you're saying. But yeah, point well taken.
Let me just add to Albert's point.
Sure.
Couldn't the wholesaler, if they have a high frequency technology, which undoubtedly they would have, they can put a bid in a penny better than what the best bid is so far, if that's what the information content of the fact that it's a retail order would have them do, and they can do that before the quote is fully disseminated, and then other people respond to that, the trade is fully disseminated, and other people respond to that trade by trying to do the same thing.
I suppose they can, but I sort of think that might fall in the category of trading ahead of your customer order, depending on how FINRA or the SEC could interpret that, if I understand correctly your point.
Well, my point is that you execute the order,
okay.
put out the print of the execution, and at the same time post a bid improvement for that stock because you have this information that the bid should be improved. That can't be trading ahead. The customer's order is executed.
It is not.
It's
yes, it is
executed
not.
at a better.
Yes, it is executed already. Yes,
it's
yes,
executed
I
and
agree.
it's executed at a better price than where you're bidding. So there's nothing. It wouldn't even be trading ahead if I put the bid in at the improved penny and then executed my order, because that would be trading behind, right? Not trading ahead.
Yes. No, I agree
customer.
with that. No, I agree with that. I was just like maybe like the FINRA could interpret it because the information is not public yet. But I think again that's a fair point. But I guess that points out to the same selection issue that Albert was bringing up. And like what we do in the paper is sort of goes in the opposite direction in the sense that it says, well, if they internalize, they must be, they offer price improvement, they must be making money elsewhere. And that elsewhere is when they get to charge institutional investors for liquidity provision, which is not consistent with what Pete and Albert just suggested, I think. There was a question in the chat.
I think this is more of a.
Yes. So yeah. So yeah. There's a paper by Jonathan in Chester that I think talks about this sort of situation as well. You're right.
Yeah, I'll keep an eye on the chat and I'll flag you if there's like questions pop up in there.
Very good. Thank you so much. Okay. So going forward. Just a quick review of the BJZZ's algorithm. So they focus on off-exchange transactions from regular hours, namely intraday, and that's an important point. They calculate the sub-penny increment for each transaction in cents, I suppose. That's going to be a number between 0 and 1. And then it classifies a transaction as a buy retail trade if the sub-penny increments is over 0.6 cents, and as a sell if the sub-penny increment is below 0.4 of a cent. The 0.4 and 0.6 thresholds are set such that you avoid the midpoint, presumably institutional executions. And then with these trades, you can construct two versions of market retail order flow imbalance, one based on volume, one based on trade. So I'm basically going back to the question that Albert and Pete were also interested about, is marketable retail order imbalance captured by this algorithm actually proxies marketable retail trade imbalance, right? So that's the first question I want to get to. One potential interpretation that could provide a positive answer to this question is the following. So suppose that the retail broker basically outsources the execution of all retail order flow to a wholesaler, right? The wholesaler internalizes all the marketable orders, but does not internalize the non-marketable orders, right? And supposedly in the process of internalization, there's going to be price improvements offered, and then they're going to be picked up by the BJZZ's algorithm, right? So whatever that is not internalized is non-marketable orders, and they're going to be rerouted to other trading venues, okay? So the point here is that if all the marketable retail orders are internalized, and assuming that a good chunk of them receive price improvement, then the result is going to be that whenever the underlying marketable retail order flow is unbalanced, you're going to have unbalanced internalized retail order flow, which is going to show up as unbalanced MRET. So that's one interpretation that could basically provide a positive answer to the question I posed above the slide. But there are a couple of issues with this, and I try to go through them. So issue one is basically the fact that from the 606 filings, which are virtually our only source of disclosure, which gives us information about the activities of wholesalers. basically show us that a significant fraction of internalized retail order flow are non-marketable limit order flows, right? Which is sort of inconsistent with my interpretation in the previous slide. So you could do back of the envelope calculations of the distributions of the orders that are handled by a wholesaler and the volume that is eventually internalized. So you can clearly see that like by comparing these two columns here, that the wholesalers have a much stronger appetite for internalizing market and marketable limit orders compared to non-marketable limit orders, right? And this is consistent with the idea that market and marketable limit orders are more likely to come from less sophisticated investors, point one, so less toxic. And secondly, they probably provide better profit opportunities if they're matched up with the orders from the opposite sides, right? But what is really interesting though, is that despite the fact that they internalize less intensively non-marketable limit orders, they pay 3 times the payment for order flow for the non-marketable limit orders. Of course, this reflects to some extent the competition from exchanges and the fact that the liquidity rebate is about 30 basis points, right? So that's basically the benchmark where they have to beat. Nonetheless, the fact that they are willing to pay for these orders would basically suggest that the non-market limit orders could be the marginal order type in this internalization process, or whatever that is internalized and picked up by the algorithm that we're talking about. So what is very important here is whether or not non-marketable limit orders receive price improvement, or the non-marketable limit orders detected by this algorithm receive price improvement. Because if they do, then they're going to have an impact on MROIB, which is going to grossly violate the interpretation I provided in the previous slide. Because whatever I had in the previous slide was based on the imbalance of marketable retail order flow. Now we have a bunch of non-marketable limit order flow that are internalized. So in order to see whether there is price improvement associated with this type of orders, we did a quick check of a sample of a random sample of 100 stocks in our sample, and calculated, or basically plotted the histogram of the volume associated with different levels of sub-penny price improvements in cents, right? So it is clear that you have some sort of agreement-driven values for the magnitude of price improvements that might have something to do with how the agreements work. It's not necessarily what we're interested in, but the point is that there is significant variation in the amount of price improvement. Okay, so what we are interested in is whether or not any of these price improvements are associated with non-marketable limit orders. Okay. So what we do to answer that question is that we calculate the share of trade executions for each of these long bars that are associated with a transaction price that is by more than 1 cent inside the NBBO at the time of execution. Okay, and we posit that that is going to proxy for the intensity of non-marketable limit orders that are being internalized and also receive price improvements in this process. So as you could see, this ratio is going up it has a very steep increase as the amount of price improvement increases, which suggests that non-marketable orders also receive price improvements, and they also receive bigger price improvements as they are posted further inside the NBBO. As a result, they're going to have an impact on MROIB. Okay. Overall, we estimate that roughly about 60% of the internalized non-marketable limit volume picked up by this algorithm receive price improvement by comparing numbers from 606 filings as well as our estimates. So that's issue one, which means that we probably can cross off the marketable qualifier from the question. Now the question boils down to whether MROIB approximates a retail trade imbalance, right? So, and this—
Can I ask a quick
yeah,
question?
sure.
So could you shed some light on the agreements, I would say, about between wholesalers and retail brokers? Are there any constraints maybe or conditions that wholesalers has to fill when they buy retail order flow from retail brokers? And do they have to actually sometimes internalize some trade that they would not internalize without these agreements?
I think that's a great question. We are really interested to understand the agreements. What I have learned over the past month or two is that, at least talking to some people who are familiar with this, that these agreements are not typically even written. They're like shake hand deals. And I think it's going to be very difficult to get into the details of those. One test that we're trying to do is to see whether we can relate the magnitude of price improvements to the bid-ask spreads, for example. You could also imagine situations where the price improvements are also a function of the trade size that is being internalized. But in terms of limitations or the minimum internalization, stuff like that, I honestly have no idea whether there are such things, but that's definitely something that I would be happy to investigate. Thank you so much. Okay, so getting back to question whether MROIB proxies retail trade imbalance. And that brings us to the second issue, and that's the inventory management concerns. So the facts from regulatory reports, for example, would basically tell us that wholesalers exhibit significant discretion over what they internalize. For example, only 70% of the market orders that they handle are internalized. So 30% of the market orders, which are like almost free money, are not internalized. And the question is why? Well, one answer to that why could be that, if they internalize everything and the underlying retail order flow is unbalanced, this means that they're going to be accumulating some inventory. Now, if the interpretation that this order flow is informed is correct, that means that that inventory is going to be highly risky, which essentially means that the wholesaler is paying PFOF and possibly price improvement to get exposed to toxic order flow and accumulate risky inventory. And that doesn't stop there. If you recall, the payment for order flow for non-marketable orders was even bigger. And presuming that non-marketable orders come from more sophisticated investors, then possibly that's more toxic order flow. So it's going to be like, okay, they're paying more PFOF to get more toxic orders and accumulate more toxic inventory. And that does not seem fully consistent with what we understand from how market makers operate. So this is why we're going to offer an alternative view of how the internalization works. So the retail broker outsources handling of the retail order flow to a wholesaler, right? Now, the wholesaler may face unbalanced retail order flow coming in, right? And they have to decide what to do with the exhaust, right? So to the extent that internalization of equal amounts of buy and sell orders is going to work, they're going to just internalize an equal amount, make the profits, and then their problem is how to deal with the exhaust. So the first option they have is that they could try to post proprietary orders on an exchange or a dark pool. And as long as those orders are filled, they can execute the exhaust accordingly, right? But this is going to be probably a costly option, given that they might have to, pay liquidity fees or access fees and stuff like that. The second option that they have is to basically reroute the exhaust for good to another trading venue, just take it off their shoulders, which means that, well, it's a costless option, but at the same time, it means that they're not filling some of the orders that they were supposed to handle, and that probably isn't a great look. The third option could be the matching of the exhaust with institutional order flow that they receive on their ping pools or the single dealer platforms. Okay, so on these platforms, the institutions would come in and submit typically immediate or cancel orders, keep pinging basically the wholesaler for liquidity. And if the wholesaler has something out there as an exhaust, they can just match it with this institutional order flow from the opposite side, and everybody's going to be happy. And guess what? It's not that costly, right? If anything, they can make some access fee that they charge the institutions for their access to the single dealer platforms. Okay. Now, as soon as we allow for this third option, where is the market making against institutions on single dealer platforms or possibly other venues too, you could imagine a situation where the dynamics are different in the sense that the institutional demand for liquidity is going to drive the internalization choices of the wholesaler. So there could be a situation where institutional demand is so high and lucrative, pinging the SDP of a wholesaler, that would make the wholesaler to internalize disproportionately on the opposite side of the institutional flow, right? Just to make the big spread, right? That might be the optimal strategy in that situation, right? So we provide a simple theoretical example in the paper to sort of make this case in like marginal profit, marginal cost analysis. But for the sake of time, I'm going to skip that, given that the intuition should be sort of clear. So like the paper begins now. So what are we trying to achieve? So first, we're going to try to establish the influence of wholesaler economic incentives on MROIB. Second, we're going to try to uncover the link between institutional liquidity demand and MROIB. And third, we're going to try to explain MROIB's predicting power for future returns. Okay, our data is fairly set. Yes.
Can I ask a question about positioning?
Sure. I can't.
Gideon, we seem to have lost you here.
Yes.
And we're running out of time.
When you started to talk, you said, can you hear me?
Yeah, we can hear you now.
Gideon.
Okay. I'm trying to figure out positioning because when you started at the introduction, you said, this is about retail supplying liquidity to institutions. And in your mission right now, you said something completely different. There was no mention of anything except MROID. And I'm trying to understand, right? I mean, in my paper with Ron and Sheridan in 2008, that's our main message, right? Individuals provide liquidity to meet institutional demand for immediacy. So we knew that. I was searching quickly in your paper to see how you differentiate it. And you don't. You basically said we extended literature on liquidity provision by retail and you cite us. So is this paper really the main thing is about the MROID measure? And that it doesn't say what Eckhart and Charles and Joanne are saying that it says, or is this paper about something new about the nature of retail liquidity provision? That's kind of so far I'm not getting the message. I mean, is there something about wholesalers, right? Because you've been talking about wholesalers all the time. Let's say we took wholesalers out of the market. Everybody, retail institutions, just send all the orders to the same, market, the same trading venue. Is it going to be different, right? The imbalance of retails will impact returns differently than in the current situation where there are wholesalers in the picture.
Yeah, I think that's a great question. So in some sense, I think that what the paper is trying to achieve is highlight how wholesalers intermediate between the retail and institutional investors, which is directly related to your point. What would happen if they didn't exist, if the retail order flow would have gone to another venue? So you can think of like different scenarios. I think that if you think about, for example, the paper that Tom Chester and Jonathan have, they mentioned somewhere that there is, for example, this delayed dissemination of information if if a trade happens off exchange, right? And institutions would value that in the sense that it would help them to conceal their intended trade sizes, right? So in the setting where retail order flow goes off exchange and institutions can go off exchange to potentially get exposed to that retail order flow, they would value the situation, right? And the provision of liquidity by retail investors to institutions without even retail investors knowing it is something that we're trying to show, right? So the idea here is that the wholesalers are acting as an intermediary who could attract institutions in the sense that they can offer secrecy, if you will, or protection for their intended order sizes, right, on the single dealer platforms, right? At the same time, they can offer execution services to retail brokers for various reasons, including the fact that wholesalers get the best pricing tier, for example, on exchanges, right? They can really compete over payment for order flow and provide the highest rebates for liquidity in some sense. And with them in between, they're gonna make the matching between retail order flow and institutional order flow a lot easier than it would be on a single exchange where every investor type would be interacting, because you could think of like high frequency traders getting involved and stuff like that.
Yashar, you're very short on time. Get to it.
Okay. All right. So the data is fairly standard. So TAC, Chris. Okay. So we work on the tick size pilot to show the effect of exogenous changes in spread and tick size on internalization choices. So in the first test group of the tick size, you have an increase in the minimum bid-ask spread from 1 cent to 5 cents, right? So this means that there is higher wholesaler profits associated, and we want to see what the reaction is. In the second group, you not only see a wider bid-ask spread, but also an increase in the pricing increment from 1 cent to 5 cents. The result of this increase in price increment is the higher risk of much worse execution quality for market orders, right? Which would reduce the use of market orders as a result, which is also documented in the literature. So what we find is that for the first group, a wider bid-ask spread leads to an increase in the volume that is being internalized and receives price improvement, but we don't see much change in the absolute value of the MROIB or the imbalance in the retail order flow. So basically, wholesalers internalize to maximize profit. In the second group, we see a decline in the volume associated with sub-tick or trades receiving sub-penny price improvements, which essentially is a reflection of the fact that market orders are now less used. These are the orders that are attractive for wholesalers. They internalize less because there's lack of market orders. But what is very important is that we see a massive increase in the absolute value of MROIB. So this allows us to attribute the variation in MROIB to non-marketable orders that are now accounting for a larger fraction of all the retail orders exposed to the wholesalers. Okay, so that basically does the incentives and wholesaler behavior. So in terms of how MROIB varies with institutional order flow, we follow BJZZ in sorting the stocks into deciles of MROIB on a weekly basis. And consistent with their findings, we find that return and MROIB are positively related, okay? So what is surprising is that if you decompose close-to-close returns into intraday and overnight components, you see very, very different patterns. In particular, intraday returns now move in the exact opposite direction of MROIB imbalances, right? And we sort of want to see what drives that. Now, if you plot order flow from institutions, mutual funds in particular, from Incerno, or the changes in short interest against this, you would find that basically institutions and retail trades happen on opposite sides of the market, which would basically allow us to interpret the intraday returns as institutional price pressure, okay? Well, it's not surprising that this happens, but is there some economic context to this? Well, to show that, we basically look at measures of trading costs of institutions, implementation shortfall. So as you can see, they are highest when MROIB is most extreme. So you have a U-shaped pattern in trading costs. So it's like institutions are resorting to wholesalers for liquidity when markets are least liquid. And that's also showing up in other measures of liquidity, including spreads and depth. So we have a situation where institutions paying wholesalers for liquidity when it is very expensive to raise liquidity elsewhere. And that's driving the intraday price pressure. In terms of wholesaler choices, recall the measure of inside NBBO execution ratio as our a proxy for the use of non-marketable limit orders. And notice that it follows a steep U-shaped U-shaped pattern here. Again, when the MROIB is most extreme, wholesalers are internalizing more often non-marketable limit orders and offer them a price improvement, which is going to be picked up by the BJCC's algorithm. Okay. So this is the link between institutional order flow and MROIB. Now, what explains the MROIB predictive power for future returns? So we propose a very simple explanation. So consider this 2-week interval, right? And suppose that you have overlapping such intervals. So in week T, you could have institutional buy, for example, right? That's going to create positive intraday return in form of institutional price pressure. But because the wholesaler is internalizing retail orders to meet that demand, there is negative MROIB associated with that, right? The order flow from retail seems to be negative. Retail seems to be selling. But then as this price pressure unwinds over the next week, you're going to see negative returns, mostly overnight, right? And then that's going to create a negative relationship between positive relationship between current MROIB and future returns, explaining why MROIB predicts future returns. Now, to the extent that institutional order flow is persistent over time, this positive relationship could extend for several weeks. And we know from the literature that persistence actually exists, especially for buy orders. Okay, so we have statistical evidence to support these two, but I'm going to skip those and basically conclude by saying that what we show in this paper is that imbalances in internalized retail order flow predict future returns not because retail traders are informed, but because they are providing liquidity to institutions, and institutional price pressure is followed by future price reversals. So we have a situation where quote unquote impatient institutions or prime brokers are pinging wholesalers on their single dealer platforms, and in less liquid times. The symptoms of this is a price pressure associated with this sort of outcome, as well as internalization that is tilted in the opposite direction of the institutional order flow. And basically that helps us explain the subsequent price dynamics and the predictive power of MROIB. So what we did in this paper provides the basis for a novel liquidity measure at the stock level. the absolute value of MROIB. And in ongoing work, we actually showed that it is the best characteristic liquidity measure for asset pricing with some reasonable economic grounding. It is the only measure that is priced post 2010, and the liquidity premium associated with it is economically large and significant. And I'm looking forward to getting that paper out soon. Thank you very much. I'll be around for discussions and questions.
All right, thank you very much, Yash. We're now in kind of the Q&A session, so we'll go up until the top of the hour, and then I'll do like a formal, hey, we're done, everybody, but we can keep talking if there's questions after that point. So people can just kind of jump in if they have questions.
Yeah, Yashar, I have another question. So I'm
sure.
So let me take, I know I shouldn't do it in this forum, but let me take the asset pricing perspective, okay? So you're kind of identifying this relationship, right, that has been shown before, right, between retail investors and future return. So let's take the two alternatives. You aggregate all retail and institutional investors to one exchange, and institutional imbalances eat one-sidedly into individual limit order book, right? That's kind of when you aggregate everything, versus you have this market microstructure element we call the institution of wholesalers, and they do something. What would be the difference between the way retail imbalances would impact returns differently if you just aggregate them versus have that microstructure wholesaler element? That's what I'm not sure I have understood.
Okay, so
can I take a spin on that, Yashar?
Sure,
or do you want to?
Well, I can, but go ahead.
So what you see is that the MROIB measure is really identifying when institutions have high trading costs. And so the extreme values of MROIB, and these are persistent. So stocks that have persistently high imbalances of MROIB are those with high institutional trading costs. And what you're then, so it's a way of identifying stocks that have high trading costs for institutions. And that you would only get because you're identifying, you identify that with MROIB. Presumably the patterns would be the same if they're trading in an exchange without this institutions, but it's giving you light on the presence of the institutions and the fact that their trading costs are high, and then the ones that are using it a lot. And so that's what's underlying the predictive power. So it's not that it would change anything, but it gives you light onto which stocks are expensive for institutions to trade. And because those stocks are expensive for them to trade, they demand a liquidity premium in return. And that's what's happening.
So to sort of continue on what Dan says, I totally agree with what he said. So I think it is important to recognize that this algorithm that we're talking about is only picking up a subset of retail trades that are ever executed, right? And the question is why this algorithm picks up the subset that it does. So we basically try to provide a perspective why that's the case. And the economic context for that is when institutions resort to this sort of liquidity pool that is being offered by wholesalers simply because liquidity is scarce and they're trying to get in and out of stock that are expensive to trade at that time.
Okay, so I understand. So it's basically about, it's not so much about the relationship, right? It's not so much about the predictability. It's about identifying a measure that because of the current market microstructure, because of reporting convention, you have a way of identifying the measure. And then the question is, what does the measure say, right? If Eckhart and Charles and Javier said it's a measure of informed trading, you're saying, no, it's a measure of actually the difficulty of institutionals in trading. And that's why it's a measure of their, as Dan said, their liquidity cost or execution cost or something like that.
Yeah, so if you were to look at this, and you were to look at future returns of going past 12 weeks, you would find a U-shaped relationship between the level of emerald. So you would find stocks that have high retail sell imbalances and stocks that have high retail buy imbalances are going to be those that have the highest future returns out 26 weeks, 39 weeks, 60 weeks, and so on. And what that's telling you is, again, that they're picking up this persistent illiquidity return. And it's, again, it's another way of seeing our formal tests. So it's giving you we don't present it in this current paper very much, so as not to steal thunder from our other paper, but it's important to understand. And now I've revealed it all to you guys, and so, okay, fine. Strategic marketing and all that.
Yeah, she may wish to not stop sharing your screen so people can see your face a little better.
Sure.
And so we're kind of at the top of the hour, so I'll do the formal, hey everyone, thank you for joining us at the Microstructure Exchange. We'll see you in 2 weeks. But for the rest of the time, if there's additional questions, Yash has agreed to stay on. So yeah, Jim notes here in the chat that he did 1,000 small trades and that most of his orders did not get a sub-penny fill, even when they got price improvement.
Yes, I believe that.
Yeah, which I find to be interesting. Okay. Anyone else got questions? All right. Nothing but crickets. Okay. Thanks everybody for joining us, even though I just did that. So I guess I'll see everyone when we next meet. Okay.
Very good. Thank you,
Have
everyone.
a good day, folks.